Welcome. Today in this video you're going to learn about the accounting for group disposals. Now, just like non-current assets, a parent entity could sell off its subsidiaries. It could sell off the investments that they do in their subsidiaries. Now, when an investment is being sold, the accounting implications can be looked in two perspectives. The first perspective is going to be at the perspective of the parent itself on the individual financial statements. The second perspective is going to be on the group financial statements. How does this affect the group? So today we will be focusing on those areas. How do we account for it in the group's perspective, and how do we account for the disposal in the individual parent's perspective? When we look into this in the parent's perspective, the parent has an investment, and that investment has been sold to a certain purchase consideration. So the profit or loss that the parent has made is going to be the difference between the sales proceeds and the cost of the investment. So this is very similar to a disposal of an non-current asset. But when you look into this in the group's perspective, it's quite a little complicated, because we recognized goodwill when we purchased the subsidiary. If we dispose the subsidiary, that goodwill is no more. Then we used to consolidate the assets, the liabilities, the incomes, the expenses of the subsidiary when we prepared the consolidated financial statements. But once the subsidiary is been sold, we will not be consolidating the performance of the subsidiary. If the subsidiary was sold mid-year, as far as incomes and expenses are concerned, we will have to recognize the incomes and expenses, or we'll have to recognize our share of profits that was made by the subsidiary until it was disposed. We will lose ownership, or we will not have any share of incomes and expenses of the subsidiary since the date of disposal. But when you look at the statement of financial position, the statement of financial position is prepared as at a certain date. If we don't own the subsidiary as at that date, then we do not need to consolidate the assets and the liabilities of the subsidiary. However, when you take your group retained earnings, you would have to see what is the share of profits that we have made before the subsidiary was disposed. Okay, right. So let's look into this with a question. In this video, I'm going to run you through the calculation to all the individual statement of profit or loss and the financial statements of the parent. And I will also run you through the consolidated financial statement, the group profit and loss on the disposal of the subsidiary. While doing it, I will be also running you through the 5 workings or the mechanics of consolidation. Now, we need to do these 5 mechanics of consolidation either way to calculate the gain or loss on the disposal of the subsidiary, right? So I have already put down the formats and all of it. So let's go through the question and see how it works out. The following information relate to P group. The statements as of 31st December is given to you. There is a statement of profit or loss and the statement of financial position. P group uses the fair value method to value the NCI. The NCI on acquisition is 700. So the NCI on acquisition, that stands at 700. The P group acquired 80% of the subsidiary. So the share of ownership is going to be 80%. And the reserves were 500 when it was acquired. The parent disposed the subsidiary on 1st of July 2019. So on 1st of July 2019, the parent disposed the subsidiary. Now looking at our financial statements, our year end was 31st December. So this is going to be a mid-year disposal. So this is basically dispersed on 1st of July. So we have only had the subsidiary in our organization for 6 months only. You are required to calculate the profit or loss to be recognized by the parent. Prepare the group consolidated statements. Calculate the group profit or loss on disposal. I start by looking at the profit or loss on disposal to be recognized by the parent. So there's a standard pro forma that needs to be looked into it. So first you have the consideration received on disposal. Then next you have the cost of the investment in the subsidiary. Now, so the consideration received on disposal is $5,000, and the cost of the investment in the subsidiary is $2,000, which you can take from the statement of financial position. So you see a gain on disposal of subsidiary. So this gain of disposal will be shown at 3,000. So this gain is going to be shown in the statement of profit or loss. Then investment will be removed from the parent's individual financial statements. Okay, and the proceeds from the disposal will be accounted for. Right. Now we'll look into the consolidated financial statements. I have taken the extracts or the figures from our question here. So the parents' figures I have taken it here. But when you look at the subsidiaries figures, I have only taken 6 months of incomes and expenses. The reason is we have only owned the subsidiary for 6 months. So the incomes and expenses that we take for our consolidation purposes has to be just only for 6 months, right? So I have basically added full year's parents' results and 6 months of the subsidiaries results together. Okay, and then here your consolidated statement of financial position. When you look at your consolidated statement of financial position, we do not need to add the subsidiaries' assets and liabilities. The reason for that is that the subsidiary is sold. So if the subsidiary has been sold, then we don't own the subsidiary's assets and liabilities. So we will only be showing the parent's assets and liabilities here. So the property, plant and equipment, we got 5,000 coming from the parent. The investment in the subsidiary, this needs to get removed actually, right? So they are not accounted for it. We will have to account for this introduction or the remove disposal of the subsidiary. Then the ordinary share capital, we will only show the parent's ordinary share capital, that's 4,000. Reserves, we are going to get it from working number 4. The loans, again we will be showing the parents' figures, which is 1,000. Right. Okay. So now I'm not going to put down the group structure working number 1, right? Because The group is not existent anymore, right? So I'll start with working number 2 itself. So we'll calculate the net assets of the subsidiary. So when you look at the subsidiary, the net assets are going to be the ordinary share capital. So you have the share capital. The share capital of the subsidiary, that is going to be 1000. The share capital of the subsidiary is going to be 1000. So share capital 1000. Then you have your reserves. Now on disposal, the reserves are 1500 that they are given, but this figure includes the total profits that was generated in the year. We need to do a special calculation and see what is our reserves at the date of disposal. But on acquisition, we know that it is 500. So I'll add in an additional note, which is your reserves on disposal. So your closing retained earnings, that is going to be 1500. From this we need to remove the post disposal profits. So after the date of disposal, the subsidiary has been in operation for 6 months. So we will be removing 6 months of profits from the subsidiary. So 150 was the profit for the year. So that into 6/12, we will be removing profits of 75. So reserves on disposal, that would be 1500 minus 75, that's 1425. So your reserves on disposal would be 1425. So we look at a growth of 925 from our subsidiary. So other than for this, we don't see any other net assets here, so we can take the total. So as at the date of disposal, the total of net assets is 2425. 2425. Then as at the date of acquisition, it's 1500. So the growth is 925. So with this, we can move on to working number 3, which is the goodwill calculation. So the investment in the subsidiary, that is 2000. The fair value of the NCI on acquisition that given us in the question, which was 700. So the total investment by the parent and the NCI is going to be 2700. So the fair value of your net assets was 1500 on the date of acquisition. So your goodwill is going to be 2700 minus 1500. That will be 1200. Now this I will not be taking to my statement of financial position. The reason is I have sold the subsidiary. This would be taken into my disposal calculation. Working number 4 is going to be on the group retained earnings. The parent's retained earnings, that is going to be 2000. Growth of subsidiaries net assets. So the subsidiaries net assets had grown by 925. We as the parent, we get 80%. So 40. So this working we cannot complete it because we need to get the profit or loss on the group disposal. So we'll have to leave working for until we do that calculation. Then working number 5, your non-controlling interest. The fair value on acquisition was 700. The growth of your net assets is going to be 925. The NCI owns 20%. So that's going to be 185. So the fair value of NCI on disposal date is going to be 700 plus 185. That will be 885. Right, now I'm going to start with the working for profit or loss on disposal for the group. Now the pro forma is you take the consideration received. So the consideration received was 5,000. Now I need to look at the cost of the subsidiary at the date of disposal. To do that, I'll be taking the fair value of net assets on disposal, and I would be adding the goodwill at the date of disposal, because I'll be losing the goodwill as well, right, as an asset. So goodwill on disposal will be added onto it, and then you will be reducing the share that belongs to the NCI. So less the fair value of NCI on disposal. Okay, right. So the fair value of the net assets on disposal, we get it from working number 2, which is our net assets working. So it comes to 2425. So fair value at the net assets on the date of disposal will be 2425. The goodwill on disposal, that would be taken from working number 3. So the goodwill is 1,200. The fair value of the NCI, that you can take it from working number 5, that's 885. So you take the total of this, you will get the cost of your investment. So you will add these two together and you will reduce the fair value of the NCI. So 2740 is going to be the value of your cost of the investment. So 5,000 minus 2740, 2,260 is going to be your group profit or loss on disposal. So here you are looking at a profit. So you have a group profit on disposal of subsidiary. Right. So this 2,260 needs to be taken into our group retained earnings. So gain on disposal of subsidiary, that is going to be 2,260. That is where you show it in your statement of financial position. Now we are preparing the statement of profit or loss as well. So in our statement of profit or loss, just after operating profit, we can show the gain on disposal of subsidiary. So the gain on disposal on subsidiary was 2,260. Right. Now, when you look at the financial statement, we see that the parent has not removed the subsidiary yet. He has not accounted for the disposal. Right? So, here under my consolidated statement of financial position, right, I will be recognizing an asset for cash to receive to record the cash receipts, right? So you can be cash or bank. So that is going to be 5,000 because that was your proceeds from the disposal. All right. The investment of 2,000, we have removed it straight away. So with that, we are done with all the adjustments. We can finish up our workings. So we have completed up to working number 3. So working number 4, let's finish it up. So your group retained earnings would add up to 5,000. So from working number 4, you are getting your group retained earnings, which is 5,000. Now the NCI will not be shown, right, because the subsidiary has been sold, so we don't have the NCI anymore, right? So this is basically the end when it comes to the consolidated statement of financial position. So you can balance it up. The total of your assets is 10,000. The total equity and liability will also be 10,000. Let's finish up our consolidated statement of profit or loss. So you see that we have a profit after tax of 2,635. Now we need to see what is the profit attributed. The NCI, is going to take share of profits for the time period in which we own the subsidiary. So the profit that we made for the period that we own the subsidiary was 75. So NCI will get 75 into 20%. So the NCI share of it would be 15. So your total group profit after tax was 2,635. So the difference or the balancing figure is going to be the amount for the parent. So 2,635 minus 15, 2,620 is going to be the amount attributed to the parent. Right. So this is it, guys. This is how you prepare a consolidated statement of profit and loss, a consolidated statement of financial position when there is a group disposal. And this is how you will be getting the individual profit or loss on the disposal of the subsidiary. And here under working number 6, you would be seeing the profit and loss on disposal of the subsidiary. Okay.